All right, let's dive into one of the wildest stories on the market right now. We're talking about Resolve AI, ticker RZLV. And believe me, this thing is a classic tug of war between insane growth and some serious skepticism. So, here's the puzzle that's got everyone scratching their heads. How on earth is a company with a $200 million revenue stream trading for less than $3 a share? I mean, seriously, what is the real story here? That's exactly what we're going to unpack. You've basically got two teams pulling on a rope. In one corner, you've got these rock-solid numbers and a killer client list. But in the other corner, man, you've got this storm of scary headlines, legal alerts, short reports, you name it. It's hard numbers versus loud noise. And just look at this gap. It's not just a little disconnect, it's a canyon. The stock's sitting at $2.91. Meanwhile, analysts are saying it should be worth $10. That's a massive difference, and it's why everyone is watching this stock like a hawk. Okay, so let's start with the bull case. Why are people so excited about this company? Well, for them, it's pretty simple. It's all about the numbers. You just gotta follow the money. Get this. Resolve AI just blew past an absolutely huge milestone. Their annual recurring revenue, or ARR, that's the predictable money coming in the door, is now over $200 million. And to put that into perspective, that's not just a little beat. It is double what they thought they'd make. They didn't just meet expectations, they completely shattered them. And we're not talking about fuzzy math or revenue that might show up someday. This is real money from real clients. And look at these names. Adidas, Gucci, H&M. These aren't some tiny little test runs. These are global giants that are baking Resolve's AI right into the heart of their business. Okay, so if you're a bull, this is where it gets really interesting. Management isn't shy about their goals. They're aiming for a $500 million ARR by 2026, $500 million. And if they even get close to that, the argument is that today's stock price, well, it's not just a bargain. It's like the market made a massive typo. And this whole situation creates this really cool David versus Goliath thing. You've got the retail investors, our David, all over social media talking about a potential short squeeze and fighting what they see as manipulation. Then you have the Goliaths, the big institutions, who are, just quietly buying up shares. They're not making a lot of noise. They're focused on the boring stuff, like the path to profitability and the long-term numbers. All right, that's the bull side, but now we've got to pull the rope in the other direction. For every optimistic bull, there's a pessimistic bear, and they're staring at what's called a wall of worry. The reasons this stock is so cheap are very real, and you absolutely can't just ignore them. And this quote right here, it pretty much sums up the entire bear case. The story they're telling is that RZLV is just another house of cards. A company that went public through a SPAC, that's a kind of merger that can be riskier than a normal IPO, and is just burning through cash with no real future. So what are the bears actually worried about? Well, there are a few big things. First, there's just a lot of distrust around SPACs in general. Second, you've got these legal inquiries hanging over the company. Even if they're nothing, they still look bad. Then there's the cash burn. Are they spending money too fast? And finally, the big fear, dilution. The worry that they'll have to sell more stock, making everyone else's shares worth less. And this isn't just talk. We can see it in the data. On some days, more than 40% of all the trading in the stock was from people betting against it. That's a huge number, and it puts this constant, heavy pressure on the stock price, pushing it down. Okay, so we've talked a lot about the stock market drama, but what does this company actually do? I mean, where does that $200 million come from? Well, their whole goal is to reinvent online shopping, to take it way beyond just a simple search bar. They call their big idea agentic commerce. Think of it like this. Instead of you having to type in exactly what you want, their AI acts like your own personal shopper. It's a digital concierge that already knows your style, what you've looked at before, and what you're probably looking for now. It's meant to guide you, not just give you a list of results. So how does that work in the real world? Well, imagine you're walking past a store. Your phone buzzes. It's a special offer on those exact shoes you were looking at online last night. See, it connects your online browsing with your real-world location to make the whole process from seeing it to buying it totally seamless, like one tap and you're done seamless. And they're not just waiting around for this to happen. They made a huge move recently by buying a company called Crown Peak. This was a total game changer. Right off the bat, it added about $70 million in revenue. But even more important, it gave them this massive list of big shot clients in the US and the UK that they can now sell all their cool new AI tools to. So that brings us to the big question. What's next? This standoff between the bulls and the bears, this tug of war, it can't go on forever. Something has to give. So as we look ahead, what are the key things we need to watch that could finally decide which way this stock goes? Okay, investors have their calendars marked. The next big date is January 13th. There's a huge analyst call, and you can bet everyone is waiting to hear management talk about this crazy gap between their results and the stock price. After that, any update they give in the first quarter could really light a fire under the stock, or put it out. And it's not just about that one call. There are a few other things that could totally change the story. If those legal headaches go away, that's a huge weight off their shoulders. A new big-name partner? That proves the tech is legit. But the real knockout punch, if they can show they're actually on track to hit that $500 million target. If they do that, it gets really, really hard to bet against them. Which brings us right back to where we started, to this central contradiction. You've got a company that's growing like a Silicon Valley superstar, but it's being priced like it's about to go out of business. It's just a wild mismatch. And here's the bottom line. A gap that wide between performance and price just can't last forever. It's like stretching a rubber band. Eventually, it has to snap back one way or the other. It's just not stable. So the big question is, which way does it snap? Do the hard numbers win, forcing the stock to catch up with reality? Or do the bears have it right? And does that whole wall of worry come crashing down? That's the $200 million question. Which way will it break?